Well, it's a very important distinction for a multi-asset income investor, and it's not to have favourite stocks. We're not stock pickers. We actively not only discourage, we do not allow our multi-asset income investing to stray into having favourite stocks. We have favourite investments from a collective characteristic perspective, so from a sector perspective. We like Japanese financials, we like US banks, we like UK domestic-facing businesses. What we don't like are individual stock stories that can then knock the asset allocation off course. So we work very hard to make sure that the returns, the determinant of returns of our portfolio are all about asset allocation. We're investing for total return. We're saying, is this area of the investment market one that will make the portfolio money and one that will interact nicely from a diversification perspective with the other holdings of the portfolio, and then collectively deliver to me a growing income, because that's the name of the game. The benefit of having a globally diversified multi-asset approach is that we're not hemmed in to needing to have any particular type of traditional dividend payer or high achieving dividend grower. We look at it from the other perspective that says, how do we invest to grow? How do we invest to grow these assets and then construct a portfolio that shows me a yield of about 4%, which is what our aspiration is. If we do those things and we do them well, then both the capital and the income grow. So from time to time we may well find ourselves, if the value's right, owning those bigger names, but from time to time we may not. But they're only there as collaborative drivers of that income growth. I'd say inflation's always a threat. Whether it's realistic to fear it or not is another matter. And then furthermore, the extent to which we care always has to be about where the market's priced. So if the market's priced with a complacency regarding inflation, or regarding perhaps the consequences of that would be regarding monetary policy. Now currently in gilt market, I would say the market's priced with a good degree of comfort that interest rates are going to stay low for a very long time. It's understandable they've got that comfort. The Bank of England's been telling them to be that comfortable. The risk spectrum, though, sits all on the one side of that. So the risk spectrum says the market may well change its mind about those things. So I'd be avoiding gilts. On the other hand, in the US, rate expectations seem a bit more evenly calibrated in that way. But nonetheless, when you look globally, you have to say that the scope for surprise, both to inflation and to interest rates, has to be on the upside. I would be very careful before saying that's meaningful from a real economic perspective, but it could be meaningful from a bond market perspective. I would say so. If we have to give a yes answer or a no answer, yes, I would say it's too early. And the reason I'm hesitating is that it probably doesn't matter as much as people think. It's fiddling about at the fringes. The big question is, should you raise interest rates by 1 or 2 percentage points? And the big answer is no. If you've concluded that, we don't really need to talk very much more about fiddling around with 25 or 50 basis points here and there. These things might matter more to the short end of the yield curve. And if you're long the short end of the yield curve, then you should be concerned about those things. And thankfully I'm not, so it doesn't concern me. But they matter less to the aggregate economy. The degree of debt vulnerability in the aggregate economy is still rather low, despite some of the more scary headlines that you may have seen. Top of my Christmas list this year would be a less communicative central bank, so that we move away from the minutiae of reporting inflation and GDP to the second decimal point, and maybe we say inflation's between 2 and 3, and maybe we say growth is between 1.5 and 2.5, because the sense to which we can have true sight and calibration of underlying activity, whether it be prices, whether it be growth, is we have an over-inflated sense of our own accuracy with these things, and demanding a response from the central banks for every 10 or 20 basis point deviation from expectations is something we should all calm down about. So it doesn't help the frequency of communication with central banks. I think it adds to volatility. So that would be the top of my perhaps boring Christmas list.